Hello friends, imagine checking your bank account this morning, expecting to see your regular Social Security deposit, only to find that it is suddenly smaller by $400. No one called you, no one sent you a certified letter, and your account was not hacked by an online scammer. Instead, your hard-earned retirement benefit was legally and silently cut directly at the source by a machine running inside the federal government. This is the reality for millions of middle-class seniors who are waking up to find themselves classified as wealthy by an automated system they do not even know exists. It is a penalty called IRMAA, which stands for the Income-Related Monthly Adjustment Amount. If your income falls near or above $109,000 as a single filler or $218,000 if you are married, you are in the crosshairs of this surcharge right now. I want to be perfectly clear right from the start. This isn't a scam or a fake IRS penalty. IRMAA is an official, federally mandated Medicare surcharge, and the appeal processes we are covering are the exact legal procedures established by the Social Security Administration. By the end of our conversation, you are going to understand the exact mathematical trap of the 2-year IRS lookback period, the strict short list of life-changing events that the federal government actually accepts, and the precise step-by-step process to file Form SSA-44 to erase this penalty entirely and get your money back. I am also going to reveal what I call the $1 cliff. It is a brutal tax trap where earning a single extra dollar in interest can trigger an automatic $1,000 penalty. And I will show you exactly how to use a specialized charitable shield to legally push your income back below that line. Make sure you hit the subscribe button right now. The rules governing your retirement accounts, your taxes, and your Medicare premiums are shifting every single calendar year. And the Social Security Administration is under no legal obligation to send you a warning or explain your choices before they adjust your checks. The seniors who subscribe to this channel find out about these changes in time to protect their money, while everyone else typically finds out after the cash has already left their bank accounts. Don't let your hard-earned savings become an accidental contribution to the federal treasury. To understand why your check drops without warning, you have to look at the 24-month income lag. This trap applies directly to any Medicare enrollee whose household income fluctuates because they decided to retire, sell a small business, or rebalance a stock portfolio. The core issue is that Medicare never looks at your current household income to decide what you should pay for your medical premiums right now. Instead, they look backward. The system electronically audits the federal tax return you filed 2 full years ago. This means that the final, high-paying salary you earned during your very last year of full-time work is going to trigger a massive premium penalty 2 years down the road. Even if you are completely retired, sitting at your kitchen table and living on a tight, fixed budget today, you can check this setup yourself right now by following 4 specific steps. First, go to your filing cabinet and pull out the physical paper copy of your federal tax return from 2 years ago, which is your Form 1040. Second, look directly at line 11 to locate your adjusted gross income. Third, look at your tax-exempt interest and add that figure back into the amount to find your true modified adjusted gross income. Fourth, acknowledge that this specific 2-year-old number is exactly what the Social Security Administration is auditing electronically behind the scenes to calculate your current monthly bills. Let's look at how this destroys a real budget. Consider a retired engineer named John, who is 67 years old. Back in his final working year, John worked hard and earned $150,000. On December 31st of that year, he retired completely, said goodbye to his coworkers, and walked away from that paycheck. Today, John's income is plummeted. He lives on a fixed pension of $30,000 plus his regular Social Security check. But look at the dollar math the government uses. Even though John only makes $30,000 today, the electronic system pulls his old tax return showing $150,000. Because that old salary sits well above the federal limits, the machine flags him as a high-income earner. John is forced to pay a massive monthly penalty based on a 6-figure salary he hasn't seen in 24 months, causing immediate financial strain on his current household budget. This process occurs completely automatically, without human eyes reviewing your individual circumstances. Every single autumn, the IRS transmits your electronic tax data directly to the Social Security Administration. There is no way to opt out, there is no way to hide from the data transfer. And it operates exactly the same way in all 50 states. So what exactly are the precise income boundaries that trigger this machine, and how much money do you stand to lose the moment you step over the line? This brings us directly to the first tier penalty math and the danger of the $1 cliff. This specific trap targets seniors whose modified adjusted gross income hovers right near $109,000 for single fillers, or $218,000 for married couples filing a joint return. The standard Medicare Part B premium is $202.90 a month. That is what the vast majority of retirees pay for their outpatient medical coverage. However, if your income rises even a fraction over the threshold, you do not face a gradual tax increase. You hit a rigid, unforgiving cliff. If a single person earns just $1 over $109,000, or a couple crosses $218,000, they fall off that cliff entirely. The system immediately applies the full first-tier penalty, forcing your monthly Part B premium up to $284.10. To protect yourself from this cliff, you need to follow these steps. First, compare your old modified adjusted gross income directly against the current federal limits of $109,000 for individuals or $218,000 for joint fillers. Second, if your total income sits right on the edge, double-check your records to see if your local bank issued a surprise Form 1099 tie-in for a few forgotten dollars of interest on a basic savings account. Third, prepare yourself mentally for the official initial determination letter that the Social Security Administration mails out every December detailing your premium adjustments. Fourth, calculate the exact monthly reduction this penalty will inflict on your net Social Security check. Look at how this mathematical trap caught a retiree named Susan. Susan is a single filer who decided to sell some mutual funds to simplify her finances. She sat down with her calculator and carefully managed her total income so that it came out to exactly $108,950, safely staying $50 below the danger line. But a few months later, her local bank issued a Form 1099-INT showing $60 of interest on an old account she had completely forgotten about. When you run the final math, that $60 slip pushed her total modified adjusted gross income to $109,010. Susan crossed the federal limit by exactly $10. Because of that $10 overage, the automated system stripped away her standard rate and slapped her with the Tier 1 penalty. Her monthly premium jumped from $202.90 to $284.10. That is an extra $81.20 every single month. Over the course of 12 months, that $10 oversight cost Susan a total of $974.40 in pure, non-refundable federal penalties. While this first tier is painful, the brackets scale up dramatically for higher income brackets. If a household crosses into the absolute maximum tier, the Part B premium skyrockets to $689.90 a month per person. For a married couple, that means losing over $16,500 a year out of their retirement savings just to maintain basic outpatient medical insurance. But a higher Part B premium is actually only half the story. Most seniors completely forget that the IRMAA system is structured as a double penalty that hits two entirely separate parts of your Medicare coverage at the exact same time. This secondary hit lands squarely on the Part D prescription drug surcharge. This specific penalty targets any senior who is already subject to the primary income adjustment and who holds either a standalone Part D prescription drug plan or a Medicare Advantage plan that includes built-in prescription coverage. The core of this rule is that the law enforces an entirely separate financial surcharge on top of your existing drug premiums. The most important thing to realize here is that this extra money does not go to your private insurance company, and it does not lower your out-of-pocket costs at the pharmacy counter. It is a direct penalty paid straight to the federal government. To track this extra cost, you can take 4 simple actions. First, open your monthly Medicare premium billing statement or log into your personal account on the My SSA electronic portal. Second, scan the document for a completely separate line item that is explicitly labeled Part D IRMAA. Third, make a note that this dollar amount is completely separate from the base monthly premium you already pay to private companies like Aetna, Humana, or SilverScript. Fourth, recognize that if you do not have a large enough Social Security check for the government to deduct this fee from automatically, you are required to pay this bill directly to Medicare every month. or the government will legally order your insurance company to cancel your prescription coverage entirely. Let's look at the actual math for a married couple named David and Linda. Through a combination of retirement decisions, David and Linda landed directly in Tier 2 of the federal income brackets. On the Part B side, their medical premiums automatically increased by a combined $200 every single month, but they also both hold basic standalone Part D prescription drug plans that carry a standard premium of $30 a month from their insurance provider. Because they sit in Tier 2, the automated system adds an extra surcharge of roughly $30 a month to each of their drug plans. Now, instead of just paying their standard $30 insurance premium, they are forced to pay the $30 premium plus the $30 government surcharge, bringing their total cost to $60 a month for each person. When you combine the Part B premium hike with this Part D drug surcharge, David and Linda are losing a grand total of over $3,120 from their household Social Security checks over the course of a single calendar year. You might think you can beat this system by simply dropping your prescription coverage to avoid the extra fee, but the regulations are locked tight. If you cancel your drug plan to evade the surcharge, Medicare will track your gap in coverage. The moment you re-enroll down the road, they will hit you with a permanent compounding 1% per month late enrollment penalty that sticks with you for life. You are essentially locked into the system. How do normal, lifelong middle-class workers suddenly find themselves triggering these multi-thousand-dollar traps? In most cases, it happens because they get caught in a phantom income trap, specifically driven by required minimum distributions and large-scale Roth conversions. This trap is sprung on retirees who execute major tax adjustments or who reach the age of 73. The reality is that you do not need to be clocking into a high-paying corporate office to show a modified adjusted gross income over $109,000. Completely standard retirement moves will artificially inflate your income on paper. The two most common causes are required minimum distributions, which the IRS legally forces you to withdraw from your traditional retirement accounts once you reach age 73, and large, single-year Roth IRA conversions designed to clear out future tax liabilities. You can prevent this trap by taking 4 strategic steps before you move any money. First, before you authorize a single dollar of a Roth IRA conversion, sit down and look at the official federal income brackets for the upcoming year. Second, verify that the exact dollar amount you plan to convert will not accidentally push your total household income across the $109,000 or $218,000 or $218,000 cliffs. Third, perform the complete math to determine if the long-term tax savings of the conversion are going to be completely wiped out by the short-term Medicare premium penalties you will face 2 years later. Fourth, if you must convert large accounts, break those massive transactions down into much smaller pieces distributed over multiple calendar years to keep your paper income safely below the penalty line. Consider how this mathematical reality impacted a 70-year-old retiree named Richard. Richard is fully retired, and between his company pension and his monthly Social Security checks, his regular retirement income sits at a comfortable $80,000 a year. His financial advisor, looking to save him money on future taxes, suggests that Richard convert $40,000 from his traditional IRA into a Roth IRA. Look at what happens to the math when that transaction hits his tax return. Richard's base income of $80,000 plus the $40,000 Roth conversion creates a total paper income of $120,000. With the stroke of a pen, he just crossed the $109,000 single cliff. While he might save a small amount of money on back-end income taxes years from now, that $40,000 shift travels through the automated system, and 2 years later, it triggers an automatic $1,000 Medicare penalty. The conversion was a major financial blunder because the advisor completely forgot to factor in the hidden cost of Medicare. You must also realize that selling your primary home can trigger this exact same penalty. If the capital gains on the sale of your house exceed the federal Section 121 exclusions, which cap out at $250,000 for single individuals and $500,000 for married couples, every single dollar of excess profit flows directly into your modified adjusted gross income, setting off the automated premium machine. But if you find yourself facing one of these massive premium spikes simply because you recently transitioned out of the workforce, you do not have to sit back and wait 2 years for the federal computer system to reset itself. you have the legal right to fight back immediately. This brings us to the official Form SSA-44 appeal, which acts as a life-changing event override. This legal tool belongs exclusively to seniors whose household income has dropped significantly due to a valid, government-approved, life-changing event since they filed their old tax returns. The Social Security Administration openly recognizes that the 2-year look-back rule places an unfair penalty on new retirees who made good money while working but are now living on a reduced fixed income. To fix this, they created Form SSA-44, officially titled the Medicare Income-Related Monthly Adjustment Amount Life-Changing Event Appeal. If your household income dropped because you stepped away from your job, you can use this document to legally force the government to ignore your old high-earning tax return and use your current lower estimated income instead. Filing this appeal requires 4 distinct steps. First, go to the official government website at ssa.gov and download a clean copy of Form SSA-44. Second, navigate to Step 1 on the form and check the specific box for either work stoppage or work reduction. Third, move to Step 2 and enter your new, significantly lower, estimated modified adjusted gross income for the current calendar year. Fourth, gather your official real-world documentation, such as a signed retirement letter from your corporate human resources department or an official business closure document from your accountant, and submit the entire package directly to your local Social Security field office. Let's watch how this form completely erases a penalty for a retiree named Mary, who is 66 years old. During her last full year of employment, Mary earned a salary of $140,000, which automatically triggered a major premium penalty for her current calendar year. But Mary retired completely in December of the following year, meaning her actual income for this year will only be $60,000 from her investments. Without the appeal, Mary would be forced to pay a $1,500 annual penalty based on money she is no longer making. Instead, Mary downloads Form SSA-44 and attaches her official corporate retirement letter. The Social Security Administration reviews the paperwork, accepts the appeal, completely throws out her old tax return, and recalculates her bills using her new $60,000 estimate. Because $60,000 sits safely below the $109,000 cliff, her penalty drops to exactly zero. The government immediately restores her full monthly Social Security check and issues a full cash refund for any elevated premiums they had already deducted from her account. The regulations explicitly list the only events the government will accept to grant this type of relief, which include marriage, divorce or annulment, the death of a spouse, a complete work stoppage, a permanent work reduction, the loss of income-producing property due to a natural disaster, the sudden loss of a traditional pension plan, or an official employer settlement payment. However, you need to understand that millions of seniors fill out this form every single year and find themselves immediately rejected by the government because they check the wrong boxes or misunderstand what actually qualifies as a valid life-changing event. This brings us directly to the reality of rejected appeals and what doesn't count, specifically looking at one-time capital gains rejections. This situation impacts seniors who hit the income thresholds because they decided to sell a house, cash out a long-term stock portfolio, or execute a large Roth conversion. The core fact you must accept is that Form SSA-44 is not a magic wand designed to erase high taxes. The Social Security Administration operates under incredibly strict legal guidelines for what constitutes a life-changing event. A one-time financial windfall, even if it is completely temporary and will never happen again, is explicitly excluded from the list of valid reasons for an appeal. If you find yourself in this position, you must follow these 4 sequential actions. First, review your records and realize that your premium spike was caused entirely by a one-time event, like selling an old rental property 2 years ago. Second, do not waste your time or your local office's time filing Form SSA-44, because the automated system will deny it out of hand. Third, adjust your household budget to accept that you must pay the higher premium out of pocket for the current 12-month cycle. Fourth, rest easy knowing that on January 1st of next year, the look-back window will automatically roll forward to your next tax return, your premium will reset to the standard rate, and the penalty will vanish on its own. Let's look at the numbers for a retiree named John, who is 70 years old. John decided to sell a long-held rental property, which generated a massive one-time capital gain of $150,000 on top of his regular retirement income. 2 years later, the automated system flags that gain and hits him with a total annual premium penalty of $2,500. John files Form SSA-44, arguing that the sale was a unique one-time event and that his actual living income is only $50,000. The dollar math here is absolute. The Social Security Administration completely rejects John's appeal. Under the official guidelines, a capital gain is not a life-changing event. John is forced to pay every single dollar of that $2,500 penalty throughout the 12 months of a year. However, the moment the calendar flips to January 1st of the following year, the system automatically updates to his next tax return. Since his normal income returned to $50,000, his premium immediately drops back to the standard base rate with zero action required on his part. There is, however, an important situational variation to keep in mind regarding property. If you lost an income-producing rental property because of a sudden natural disaster like a hurricane or a wildfire destroying the building, that specific event does legally qualify as a loss of income-producing property. In that disaster situation, the government will grant your appeal, whereas selling the property for a cash profit will get you denied every single time. But what happens if you didn't sell a house and you didn't retire, but your old tax return was simply processed incorrectly by the IRS? This is where you use the Amended Tax Return Fix, which serves as an official IRS correction override. This process belongs to seniors whose tax preparer made a major mathematical error on their old tax return, artificially inflating their modified adjusted gross income on paper. The core mechanism here is straightforward. If the IRS made a mistake, or if you filed an official amended tax return using Form 1040-X that successfully lowered your income back below the $109,000 or $218,000 cliffs, you can legally force the Social Security Administration to update your Medicare premiums immediately. You do not need to prove a life-changing event to get this relief. You just need to prove the original data was wrong. To execute this correction, you must follow these 4 specific steps. First, have your accountant file Form 1040-X with the IRS to permanently fix the original reporting error. Second, wait patiently for the IRS to officially process the amendment and issue an updated federal tax transcript. Third, take that physical, official IRS transcript directly into your local Social Security Administration field office. Fourth, request an official IRMAA red determination based strictly on the newly amended return data, bypassing the standard appeal form entirely. Let's look at how this fixed a budget crisis for a retiree named Susan. Susan's accountant accidentally misclassified a $30,000 traditional IRA rollover, listing it as a fully taxable distribution on her return. This error pushed her paper income up to $120,000, triggering a major automated premium penalty. The math behind this fix saved her a fortune. Susan was facing a $1,200 annual penalty that she did not actually owe. She immediately fired that accountant, filed Form 1040-X to prove the rollover was completely non-taxable, and waited for the IRS to accept the correction. The moment she received her official transcript showing her true income was only $90,000, she handed it to a representative at her local office. The government agreed her true income sat safely below the $109,000 cliff. They completely wiped out the $1,200 penalty and refunded every single dollar that had been wrongfully deducted from her checks. You must be aware of one critical compliance rule. The local office will absolutely not accept a copy of Form 1040-X that you simply printed out from your home computer. You must provide official federal documentation proving that the IRS has actually reviewed, processed, and fully accepted the amendment, which means showing them a certified IRS transcript or an official government acknowledgement letter. Now, while appealing after the fact is useful, the absolute best way to handle this premium machine is to use a completely legal tax shield to prevent your retirement income from ever hitting your federal tax return in the first place. This brings us to the ultimate payoff, the Qualified Charitable Distribution Shield, which allows you to completely bypass the standard income calculations. This strategy belongs exclusively to seniors aged 70 and a half or older who are being forced by federal law to take required minimum distributions from their pre-tax traditional retirement accounts. The core of this strategy targets the exact moment your forced distributions threaten to destroy your budget. An ordinary distribution counts directly as taxable income, which routinely pushes middle-class retirees right over the $109,000 cliff. But by utilizing a qualified charitable distribution, you can legally transfer up to an inflation index limit of over $105,000 every year directly from your traditional IRA over to a registered charity. The money satisfies your legal obligation to take a distribution, but it is completely excluded from your adjusted gross income, hiding it from the automated premium machine entirely. You can deploy this shield by taking 4 precise steps. First, look at your projected income for the year. And if you see you are trending a few $1,000s over the $109,000 or $218,000 cliffs, stop and do not take your distribution in cash. Second, instruct your official financial custodian to draft a check directly from your IRA asset and send it straight to a qualified 501c3 charity. Third, ensure the check is cut payable directly to the name of the charity and never let the funds touch your personal bank account. Fourth, report the transaction clearly on your Form 1040 line 4A, but write the letters QCD directly on line 4B so the IRS knows to completely exclude that money from your taxable income. Let's look at the multi-year dollar math for a married couple named Robert and Linda. Robert and Linda have a standard base retirement income of $210,000. Robert reached age 73, meaning he was legally required to withdraw a $15,000 distribution from his traditional IRA. If Robert takes that $15,000 in cash, it mixes into their household income, pushing their total to $225,000. This blunder forces them across the $218,000 joint cliff, triggering the Tier 1 penalty for 2 people and costing them an extra $1,948 every year in pure outpatient premiums. Instead, Robert directs his custodian to send $10,000 as a direct charitable contribution to his local church, and he takes only $5,000 in cash. Look at the math now. Their reported income drops to $215,000, keeping them safely under the $218,000 cliff. By choosing to donate that money, Robert completely avoided the $1,948 premium penalty while simultaneously wiping out his federal income tax liability on that distribution. Over a 5-year retirement window, this single legal loophole saves this couple nearly $10,000 in pure, unrecoverable premium surcharges. You must remember this vital situational constraint. A qualified charitable distribution can only be executed from a traditional IRA asset. If your retirement savings are currently sitting inside a corporate 401k plan, you cannot use this shield. You must first execute a standard rollover to move your money from the 401k into a traditional IRA, and only then can you direct your custodian to issue the charitable check to protect your income from the premium cliff. To wrap everything up, let's look at exactly what we covered today. First, remember that the federal government uses a strict 24-month income lookback period, meaning your final working wages will dictate your premiums 2 years into retirement. Second, the system is a rigid cliff. We're going just $1 over $109,000 for individuals or $218,000 for couples triggers an immediate $1,000 annual penalty. Third, this is a double hit system that automatically penalizes both your Part B outpatient coverage and your Part D prescription drug plans simultaneously. Fourth, standard retirement moves like forced distributions and single-year Roth conversions create phantom income that routinely trips this machine. Fifth, you can legally fight back using Form SSA-44 if you experienced a valid life-changing event like a complete work stoppage or retirement. Sixth, keep in mind that one-time capital gains from standard property sales are automatically rejected as valid appeal reasons. Seventh, if your accountant made an error, you can use an official IRS transcript from Form 1040-X to override the system completely. And eighth, if you are over age 70 and a half, you can deploy the Qualified Charitable Distribution Shield to completely hide your forced distributions from the federal computers. The IRMAA Surcharge is a hidden tax on your retirement success. but by understanding the 2-year look-back period and aggressively using Form SSA-44 when you retire, you can legally force the government to restore your full Social Security check.